Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, we start another quarter. Our experts weigh in on what they look forward to seeing, or maybe don't look forward to seeing in this new quarter. Executive Vice President of Zacks.com, Steve Reitmeister, Research Director Shiraz Mian, and Market Technician Kevin Matris. Unfortunately, though, Steve, we start this new quarter with all the same headwinds and problems that we left in the last quarter. Not much has changed. So this week, as we start talk here on a Monday, is it all about Europe, or is there other?
Europe is certainly something that's weighing on everybody, but even if you put that aside, we don't have economic data that's that wonderful, and I think that one of the terms that's been used is stall speed. So stall speed means that relatively we have a GDP that looks pretty close to zero, okay? Even though I think that the third quarter is going to be a little bit better than that, but the indicators don't look very good on that front. But here again, if we're anything above zero going forward, the market should go higher. If we go below zero and into a recession, the market should go lower. Until there's more proof, we're going to stay in this range that we've been in for pretty much 2 months here. So.
It just seems like the market really reacts to every little headline that comes out of Europe lately.
Yeah. Well, because that's, they keep calling it the Lehman-like event, okay? So, going back in our memory banks just 3 short years ago to when we had our problems in September and October, and Lehman and Bear Stearns and all those kind of things. And there is that kind of thing in the air in Europe if other countries, start having more of the same kind of issues that we've seen in Greece, Portugal, and Ireland. But if you take a look, their markets continue to go down. They're already in bear market territory. And even after the conversation about Germany increasing or agreeing to increase the size of the bailout fund, their markets continue to go down. So they're close to the action, and they're not feeling good about things.
Okay, Shiraz, how about that GDP data from last week? Was there any good in that report?
There was, but it was from such a long time back. It dealt with the second quarter. And if I start talking about all the positives about the second quarter, somebody may throw a shoe at me or something like that. That look ahead, talk about the new quarter. But on a serious note, yes, this was the third and final revision of the second quarter GDP numbers, and each of the revisions was a little bit better than the previous one. Yes, the headline number got down from 1.3 to 1% and then again to 1.3%, but the internals kept getting better. We have more consumer spending, we have more exports, we have more business spending, and all of those are the type of drivers we want to see continue into the third quarter. And just a brief comment on what Steve talked about. This notion that if the economy is even barely positive, I 100% agree with Steve's assessment that even if it comes at 1%, 1.5%, the market will see that as a very positive sign and will run up with it. So the expectations have been really beaten down. And that was the thing that we did in the third quarter, and that was the reason why the market performed as poorly as it did. In the fourth quarter, even if all the headwinds and the clouds are still the same that you referred to, expectations are very low. So now even modestly positive and even in-line data will be more reassuring for the market, and that should put us in relatively better position.
Kevin, you agree with that?
No, I'm going to break away from these guys. I think that, I do believe that the economy is going to grow more than 0%. I think there will be a positive read going into the end of the year, but I believe that even if we are growing at muddle-through pace, stall speed, whatever you want to call it, even if it's 1%, I still think the market is going to go down just because there's so many headwinds all around the world. Everybody seems to be either in a recession or heading towards it, even China. So I do believe there's going to be a lot of pressure.
So more room to the downside is what you're saying.
Yeah, you know, I don't want to sound like a
But
big...
but on the positive side of that, though, with all the volatility that's been going on, can investors use that volatility to their advantage?
Let me say this. Yes, I think they can use the volatility to their advantage because you can make money on the downside. You can employ strategies to make money if the market chops around. But from the downside, I do believe the S&P, because there's a big bearish, ominous bear flag pattern on the chart. I think that the market could go as low as 1,000 or 978. That's only about 13 or 15% lower from here, but it's going to feel a lot worse if and when it happens.
I just want to clear something up here. Okay?
Sure. Okay.
Okay, you're saying that even if GDP comes in positive, now are you talking about for the third quarter or the first?
Q4.
Okay. Q3 rate. I think most people are going to write off Q3 no matter what
positive.
it is. Okay,
Q3 is positive.
but if Q4 is in that same 1.5 plus range, which is what we had in the first half of the year,
right,
which produced earnings growth year over year, and with bond rates and cash paying nothing,
right,
I would have to take off my bear suit and get a little more bullish, okay? Because the odds are firmly in my favor. What I'm saying is, yeah, Q3 is going to be fine. The GDP number is going to be plus 1.5-ish to 1.7-ish would be my guess, okay? And I think most people are going to say, I don't care, it's the future, that's the issue. So I just don't think you can get that drop unless GDP
gets negative.
Gets negative or keeps slipping.
That's right.
Okay, which I think is very possible, okay? But you said that even if GDP was plus, in the plus side, that the market would still slip. I don't agree with that. I think the economy does have to move towards that 0 or less reading in order for folks to go that route because cash is so cheap.
But let me say this. The reason why, then jump in, the reason why I believe that even if it's positive in Q4, it's still going to have a negative impact because I think the story has already been set, is because when we first got the original estimate for Q1, everybody thought we had grown at 3% in the previous year, and people were just kind of putting Q1 as a blip. Now we are coming off of a 1%, and if we still get 1%, nobody has this blip mentality. People are going to be increasingly concerned, oh my goodness, if this is all we've got, we may start going lower.
But now the fear has increased to recession and not just growth. So, okay, we had just a 0.7, 0.8% growth in the first half, which was much lower than what we thought we had.
All right.
Very true.
I have to give Steve the last word on this.
And that, okay, for as low as GDP was in the first half of the year, it produced positive earnings growth.
Absolutely.
And positive earnings growth makes stocks worthwhile when Treasury bills are paying less than 2%.
That's right.
Now, I think we are going to roll past this, and I think we probably will move into recession. But if it doesn't, I'm going to take off my bear suit, put on bull suit. Let's go forward.
I got to say one thing, and then let's go.
Real quick.
The only reason why I say this is because back then, nobody was expecting China to slow the way they are slowing now. Nobody was expecting Europe to come to a screeching halt the way they are expecting now. If you look at our customer base, our foreign customers, that is where everybody needs to pay attention. If they start pulling back even more so than what everybody is fearing, our 1% more than likely is going to fritter down to something less than 1%, which is why I still believe we are going lower.
All right. Under the heading of new business. Top stock pick.
Oh, top stock, yes. Real fast, going with Watson Pharmaceuticals because got to go with defensive in this environment. Okay. But they have one of the better growth stories in the industry. So you're blending the defense with strong earnings estimate revisions. Very attractive stock, even at times like this.
All right, Shiraz.
I've been agreeing a lot with Steve today. So I'm defensive. I'm defensive. It's Mark West Energy Partners, a natural gas pipeline, fractionation and processing master limited partnership. An excellent low-risk, dividend-paying, high-yield play for these uncertain environments. Pays a distribution which currently yields about 6%. Can't go wrong with that.
All right, Kevin.
Mine is Ulta Salon Cosmetics, ticker ULTA. say they, sell cosmetics, fragrances, this kind of stuff. Let me count the ways I love them. They are Zacks #1 ranked stock, which is a strong buy. They have projected growth rates of 49% for next year, rising upward earnings estimate revisions, 11 positive EPS surprises in a row. They've got margins, net margins that are 4 times the industry, and no debt. I have a price target of $80. That's a 28% increase from here.
All right. Thanks for joining this spirited conversation here today. And remember, keep your eyes peeled on Zacks.com for any change in their thinking, in latest commentary day to day as news events unfold. With everyone here, I'm Terry Ruffalo.